What just happened to your overtime check? Your payroll system looks at your overtime check and does some quick math. It sees a bigger paycheck than usual, so it assumes, incorrectly, that you'll earn that same amount every single pay period for the entire year. And based on that assumption, it withholds taxes as if you're suddenly a much higher earner than you actually are. But you aren't. But the software doesn't know that, so the withholding can look brutal. It feels like a penalty for working harder, but it isn't a penalty. It's a natural overreaction by a computer program. And here's what actually happens at the end of the year. When you file your tax return, all the income gets totaled up and run through a real tax calculation. The payroll system's wild guess, it gets corrected. Every dollar you overpaid in withholding comes back to you as a refund. The overtime didn't get punished. The software just panicked. And your tax return fixes it. But now you need to understand why it fixes it. And that means understanding how tax brackets actually work. First, there's one term you need to know, and that's taxable income. Now, this is not your salary. That's not your gross pay either. This is what is left after deductions are subtracted. So, what kind of deductions? Think about what comes out of your paycheck before you even see it. Health insurance premiums, 401k contributions, HSA and FSA contributions. Those reduce your taxable income immediately. Then, when you file your taxes, you also subtract either the standard deduction or your itemized deductions, things like mortgage interest, charitable contributions, and certain medical expenses. Whatever is left after all that is your taxable income. That is the number that actually matters. Now, stop picturing that number as one giant pile of money getting taxed at one big rate, because that's not how it works. Think of buckets. Your taxable income fills them one at a time, and each bucket has its own tax rate. The money already sitting in a lower bucket, it stays there. You never go back and retax it. Here's how it looks for a single filer in 2026. The first $12,400 fills bucket 1, taxed at 10%. That is $1,240. The next chunk, up to $50,400, fills bucket 2, taxed at 12%. That is $4,560. Everything from there up to $105,700 fills bucket 3, taxed at 22%. Now, 3 buckets covers most working Americans. Now, the raise scenario, and here's why your fear is wrong. Now, let's put some real numbers on this. In this scenario, your taxable income is $48,000, and that's realistic for a lot of younger workers once you factor in health insurance, 401k contributions, and other pre-tax deductions. You get a raise, and that brings your taxable income up to $52,000. Now, that crosses into the 22% bracket. The panic hits, but don't panic. At $48,000, your total federal tax is $5,512. And here's how that breaks down. Bucket 1 is full. The first $12,400 is taxed at 10%. That equals $1,240. Bucket 2 isn't completely full yet. Only $35,600 lands in the 12% bucket. That equals $4,272. The 22% bucket, that's still empty. So your total federal tax at $48,000 is $5,512. Now you take the raise. Your taxable income is $52,000. You crossed into the 22% bracket. Did you make a huge mistake? No. After the raise, bucket 1 stays full. That's still $1,240. Bucket 2 now fills all the way to its top at $50,400. That is $4,560. Now the spillover begins. Only $1,600 lands in the 22% bucket. That $1,600 taxed at 22% adds $352. Your new total tax, $6,152. You earned $4,000 more. You paid $640 more in tax. You keep $3,360 of that raise. The bracket didn't swallow your raise, it taxed a thin slice of it. Now, here are 2 terms that'll change how you look at every paycheck for the rest of your life. Your marginal rate is 22%. That's the rate on your next dollar of income. Your effective rate is different. Divide your total tax by your total taxable income. At $52,000, that's $6,152 divided by $52,000. Your effective rate is just 11.8%. Think of it this way. Your marginal rate is the speed limit on the highway. Your effective rate is your actual average speed for the whole trip. You hit 70 briefly, but you didn't drive 70 the entire way. People panic about being in the 22% bracket, but they're actually paying under 12% overall. That gap, 22% on paper, under 12% in reality, is exactly why this feels so wrong and why it's so misunderstood. Your marginal rate is your ceiling on the next dollar. Your effective rate is what you actually paid. And those are two very different numbers. Never confuse them. Bonuses work the same way. And while we're here, if you've ever gotten a bonus and felt that same gut punch, well, here's why. When bonuses are paid separately, your payroll system withholds 22% flat right off the top. That's the IRS supplemental wage method. Now, the exact method can vary depending on which method your employer actually uses, but either way, it's not your actual tax. It's a prepayment, a down payment on your tax bill. And when you file, everything gets trued up. Overpaid, you get it back. Same situation, same fix, same result. The real traps, though, what should actually concern you, the brackets here aren't the trap. Here's what it actually is, and it's two things. One, self-employment income. Nothing gets withheld from your 1099 payments. You are your own payroll department. So you might want to set aside 25-30% the moment you get paid, or come April, you could get hurt badly. The other is having two jobs and the W-4 problem. This catches millions of people every single year. Each employer withholds taxes as if that job is your only income. And in this example here, we're going to assume you have two full-time jobs. Now, you make 40 grand at each job. You never sleep. You're always working. Job one withholds assuming you earn $40,000. Job two does the same. But at filing, the IRS sees one person who earned $80,000. This puts you in a higher bracket than either employer planned for. Why? Because the payroll software at both jobs didn't know you had other income. And you'll owe the difference come tax time. The fix? Update the W-4 on your primary job. There's a line specifically for extra withholding. Even $50 extra per paycheck can prevent a painful April surprise. If your income changes for any reason, a raise, a second job, a side income, revisit that W-4. The IRS has a free withholding estimator at irs.gov that tells you exactly what to put in that box. Now, for higher income earners, there are phase-out cliffs. It's beyond the scope of this video, but if you earn over $200,000 and you're a single filer, it may apply to you. Now, go back and look at the overtime checks that you get again. You weren't robbed or penalized. A payroll system made a bad assumption about your future earnings and withheld too much. Your tax return corrects it. More income, whether it's a raise, overtime, or a bonus, always means more take-home pay. The bucket system guarantees it. You earn those hours. Every dollar of them is yours to keep, minus a thin slice that was always going to the government anyway. Now you know exactly how thin that slice actually is. If this helped you understand your paycheck a little bit better, good. That's what we're here for. Help you understand your finances a little bit better each day. Now, I'll see you in the next video.